Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. And I'm not doing a weekly market update yet, but I wanted to kind of I put together some short videos on our socials. So check those out on YouTube and Facebook, Instagram, the whole thing. But I wanted to do a little bit longer form on this. We'll touch on it again in the weekly update. But we've got a new thing out with this 50-year mortgage thing. So I just wanted to kind of give you some takes on it that are out there and also my own opinion on some of this. So let's dive right in. I'm going to share my screen here with you. First off, let me see if I've got it here. Um, where is, okay. Oh, here we go. Okay. This is just kind of a quick breakdown that somebody put together that's a mortgage professional, just to kind of give you a quick idea. Obviously, they may have a little bit of a slant towards the idea that, interest only and it's median, it's supposed to be median. Sorry about the misspelling there, but home price in the US right now is at 435,000 at a 6.5% interest rate. 30-year mortgage, 2,700 a month. Total cost, obviously, these are using round numbers and round credit or just decent credit. Total cost is 989,800. So with a 50-year mortgage, you'd be looking at a little bit more buying power and or a lower monthly payment, but more in interest. Of course, everybody would assume that, and that's what that would look like just on the median home price in America right now, with a 6.5% interest rate, which as of right now is a little bit higher than where we're actually at today. But that kind of gives you kind of some round numbers to chew on there for those interested. And then from Housing Wire, we've got how much would a 50-year mortgage cost? Okay, in a social media post on Saturday, here's what President Trump did. He floated the idea of 50% mortgage rate to boost affordability. But the idea got frosty reception online. Everybody was kind of going at Bill Pulte, FHA director, with why this is a bad idea and this and that. Here's what I'm going to say right out of the gate. Here's what I'm going to say right out of the gate. Okay. In anything I do in business or in life, I like more options. Okay. I just like the idea of not being put in a box. Quite frankly, I think you're better off doing a buy down rate or an arm, which is nothing like the arms during the crash. They're totally different type arms. Yet right now you have to be, basically where the 30-year fix would be at to even qualify. It's under qualified mortgage and all that. Um, so arms are definitely a way to go, or just a buy down rate. I like the buy down rates even more, where you basically get a seller or builder to give you a lower rate the first, second, or third year, or just a lower fixed rate. But you end up way ahead of where you would have been in tons of savings right out of the gate just doing that. Okay. I mean, just on a 100 basis point lower or 1% lower, getting concessions paid for by a seller or builder, you're going to save about 250 to 300, depending on credit and all the other dealios you're looking at. You're looking at around 250 to $300 a month savings just doing that. Okay, per month. I remember in all this, you can always uh, pay more on the principal. Okay, you can always pay the home off earlier. Most people are not at homes more than 7 to 9 years, even now. So, most people don't stay with the same loan for more than a few years. Okay. That's just the reality of it because people refinance or they pull equity out, and things like that. So, to think that somebody's going to sit there with the same mortgage or the same house or mortgage for 50 years isn't even true with a 30 year. Okay. So let's get that right out there out of the gate. Okay. Um, And if you're somebody who can leverage debt well, if you're somebody who can leverage debt well, okay, and you can afford to buy in the first place, okay, you're still, going to be ahead if you know what you're doing and you're working with good mortgage professional, a good agent that can kind of go through all these things with you. Okay. The other thing I would point out, just like anything that gets juiced, whether it's the 30-year that we have now that we've had since Roosevelt, 50-year, whether it's the buy down rates, all these other things, arm rates, all that stuff does inflate the market. Right now, if the builders were not offering buy down rates, and Bill Pulte even said this the other day, keep in mind though, the builders are not the march of dimes. They're in this to make money, just like any other business person. Okay. They're the ones putting the capital out and the risks out. But if they weren't doing buy down rates right now, what would happen? They would have to have lower prices, right? So that's juicing their business, but it's all legal to do those sorts of things and to offer those lower rates and buy down those rates for buyers. Okay. So that's what's keeping the doors open. That's what's keeping those prices elevated more than they would be if we didn't have the buy down rates. They would be lowering prices or having price reductions even more. A $10,000 price reduction is going to save you about 80 to 90 bucks a month. Okay, depending on where the rates are that day. Okay, and the current range we're in now. Okay, and depending on credit and all the things. Okay, um, but when it comes to the buy down rate, okay, you've got a lot more you can buy more house and or save that money that we already talked about. So by doing this, if they do this, and it has to be, right now, 30 years really the only thing that's legal. They tried 35-year, 40-year before, and then it was banned in 2010. Okay. Um, there's some situations where some of that may be, they were looking at restructuring and foreclosures and all that, but it was basically banned in 2010. Okay. So by doing this, you're doing something to enhance the market for a home buyer, which means it could drive prices up more, but it makes it a little bit more affordable for a home buyer. So we saw the numbers there. Basically, a lot of people are throwing numbers out, or it's going to save you around a couple $100 a month in a payment, or juice you to maybe 40 or 50 grand on a purchase price. So now you can really buy maybe the house that you want or in the area you want, the size home you want. Okay. That's really the take on this. If you want to look at kind of some of those angles, I hope that makes sense. But if you're a home buyer thinking about buying a house right now, I'm telling you, I'm not just saying this because I'm a realtor, because if prices go down, I'll sell even more properties. Okay. Has nothing to do with, oh, I just want to get a commission. No, no, I'm just not looking for compensation. I'm actually telling you what happens. It's like supply and demand or anything else. Um, if they do this, prices will be enhanced. In other words, they'll go up. Okay. Um, by doing this. Okay. That's just the nature of the beast, but it'll be more affordable, especially for first time home buyers to get in. Yes, you're paying more in interest, but we're all leveraging interest. Okay. Whether it's a 30-year, 50-year, whatever. You can buy down, you can get the buy down rates. You got these other options. You can always pay down your principal. You could take that extra couple $100 a month and pay it on your principal every month. Or you can just look at it as a leverage situation. I was talking to some people today and they were like, yeah, I might just do this because then I can leverage, investments. So there's all these sorts of things. And obviously some of that's whether it's primary or not and all that, of course. Um, we're not looking for anybody to break the law. But if they're looking to maybe go into a primary, you know, they may leverage it that way, and then rent out their other property they have or sell it or whatever. But Anyways, okay, so just to dig into this a little bit more, housing lead wire analysis or analyst Logan Motoshami, who I love, don't always agree on everything, but he points out some good points here in this article on Housing Wire. What the rate on a 50-year loan could look like. Traditionally, the longer the amortization, the higher the mortgage rate, said Motoshami. Looking at the difference between a 20-year mortgage and a 30-year mortgage, the best scenario for a government-backed 50-year product would put rates most likely between 0.42 to 0.57% higher than a 30-year. So in other words, the rate's going to go up, but it's going to be more affordable because you're stretching it out. Okay. Again, unless they tweak that, that's pretty much what you're looking at. If they're going to tweak that or regulate that somehow, using the 30-year fixed mortgage rate at the close of Friday at 6.32, you could be looking at mortgage rates at 6.74 to 6.89 for a 50-year loan. It could be higher than that, but that's the best case scenario I see, said Logan Motoshami. Taking that and using 6.8 for 50 year, here are the payments. And then he breaks them down here below in these charts. Okay. And says, according to the Fannie Mae mortgage calculator, different price points, this is the only calculator. Principal and interest as of the rest of the monthly payment. Taxes and insurance vary too much by location to provide valuable averages. So this was out without taxes and insurance. Okay. So 300, 400, 500,000, 30-year versus 50-year, the interest rate difference that he was talking about in the current world, if they were to boost that to a 50-year, monthly principal and interest and paid interest. Okay, so this is the breakdown here. Okay, I don't need to read through all those numbers. Below is another view, different. I'm sorry. Now, below is another view of the difference in interest payments over the life of the loan between the two loan terms. Okay. So there's a breakdown of that. So you can see the difference in 300, 400, and 500,000, the 50-year versus the 30-year. Okay. Obviously, if you can pay cash, obviously, if you can do a 15-year or less, all those things are great. But with qualified mortgages and not non-QM, which are not qualified mortgages, this is basically what you're looking at. So qualified mortgage, that's basically what we've had since the crash, and that really changed the market too in a lot of ways. Obviously for the good in many ways, but things since then, also we see, maybe move a little bit slower, maybe a little bit less inventory on the market, things like that, just because of what happened back then. Builders are not the march of dimes, as Logan Motoshami puts it. And so they're always playing catch up with the market. They're never building enough or more than enough homes like maybe they were back then when we had way too much inventory. You could pretty much double, even, in many areas, triple the amount of inventory that you have right now in many cases. In your local area, and it would not bring about the crash or not even be close to what we had back then. Plus, you had people that were losing houses, not buying houses after they, short sold the house or lost the house. You had 250 to 400,000 homes coming on the market. We're lucky, this past year, if we were hitting 70 to 80, that was fantastic. Logan usually says he likes to see across the country around, 100, 110,000 at any given week. So the regulatory challenges could mean higher rates. So we talked about that earlier. The interest difference could be much starker depending on how a 50-year mortgage is structured for the market. After the great financial crisis, Congress passed the Dodd-Frank Wall Street Protection Act, which stipulated the kinds of mortgages that Fannie Mae and Freddie Mac would buy on the secondary market. The 50-year mortgage would not violate the Dodd-Frank Act outright, but it would not qualify as a qualified mortgage under the Act's ability to repay ATR rules, said James Brody, managing partner at Brody Gap. Current regulations cap QM loans at a 30-year term, so loans exceeding that duration fall outside of standards. Okay. Basically, they're not allowed. Um, in practice, this means a 50-year loan could only be originated as a non QM mortgage, which lacks the legal safe harbor protections of a QM and typically carries higher interest rates unless the ATR rules are amended to include 50-year terms. Lenders would be unable to sell these loans to the GSE, Fannie and Freddie Mac, severely limiting the product's liquidity. Okay. In short, while not legal or not illegal, 50-year mortgages have very limited stability in the secondary market under the current Dodd-Frank framework. Okay, so that's from Logan over at Housing Wire. Realtor.com, I thought this was a pretty good article here too. President Trump proposes the 50-year mortgage, provoking, strong debate about pros and cons. Trump floats the idea over the weekend through True Social. Bill Pulte says, "Yeah, we're working on it." President Trump is always exploring ways to improve housing affordability. I mean, at least he's looking at things to help affordability. Again, you can always refi, pay down things, earlier. All that you can leverage that. You can always pay more. All those things. So for home buyers, 50-year mortgage would offer lower payments compared to 30-year standards. Trade-offs have sharply divided reaction, blah, blah, blah. And then we have this was out over the weekend, this photo here. The appeal, 50-year mortgage is offered to lower monthly payments. The drawbacks are 50-year mortgage result in double the interest payment in a 30-year mortgage and a longer path to meaningful home equity. Okay. The subsidized demand would increase home supply. Okay. Without increasing home supply, sorry, 50-year mortgages could drive home prices higher. That's exactly what I was talking about, wiping out any potential savings on monthly payments. Lawrence Yun, chief economist at National Association of Realtors, says that the small savings on the monthly payment for the 50-year mortgage would come with significant trade-offs. The slow equity build would make trading up or down very difficult. He says it would also take almost 40 years to pay off half of the balance, meaning the borrowers would not begin building meaningful equity until the final decade. Currently, 50-year fixed mortgage rate mortgages are not allowed. We talked about that. How a 50-year mortgage, let's see, concerns. Okay, our concerns is that if any affordability benefit derived from expanded 50-year would be offset by increased borrower risk and slower borrower equity growth resulting from the expanded amortization period, especially given the expected slowing home price growth, the MBA spokesman said. We kind of went through the change in payments, but this says here, assuming for the sake of argument that mortgage rates were equal across both products, the 50-year mortgage would lower mortgage payments by $250 per month on a $400,000 home, assuming 10% down and a 6.25% mortgage rate. Total interest payment over the life of the 50-year loan would amount to $816,000 compared to $438,000 on a 30-year, a difference of $378,000. That's a big difference. That amounts to 86% more interest over the life of the loan. Buyers do not benefit from spreading out the high cost of home purchase over a long period, but lenders certainly benefit by having a longer period to charge higher interest rates, says Berner. So we know where he stands. So a lot of people, are saying this is just, a way for the banks to make more money. and those sorts of things, which obviously you can see that in the, financing. They are going to make more money on these loans. They're the ones lending the money out though. So, it's a matter of leveraging. Would a 50-year mortgage drive up home prices? Sorry. Housing economists fear that unintentional effect of 50-year mortgage would be raise home prices overall, wiping out the purported benefits. Savings from 50-year mortgages may be totally negative by rising home prices. Okay. That is definitely a concern. That's what I was saying earlier. If this happens, you definitely want to get out there and buy a house sooner rather than later. Okay. Because then you're gonna be dealing with this also. I still say I think the idea of uh, buy down rates, even though that does drive prices too, is a way to handle that until we do get more supply, which lower interest rates, lower Fed's fund rate, the direction of the Fed, whether they're dovish or hawkish, it's not a one for one, but it does drive the markets. It does have a relationship with the 10-year treasury, which then has a relationship and an effect on the 30-year mortgage rate. Not a one for one. Usually the bond market's way ahead too. But if they know that the Fed is going to be more accommodative, more dovish, then we get the Fed fund rate down. And then in effect, we will see through their policy get the mortgage rate down. I think that's the answer here. And when people will say, well, yeah, but Chris, you know, it's it's you know, we're not seeing the numbers, right? Well, I actually in a separate video I'm going to put together from I actually put together some stuff from Barry Habib in the last couple of weeks for you guys. The inflation rate, if you understand how to read the numbers correctly, which evidently Powell doesn't, he's not an economist, or he's being political. But whatever the case may be, if you understand the owner's equivalent rent, you understand that makes up a third of inflation, and you understand that right now where that is actually right around 2%, along with the services industry when it comes to basically who's managing portfolios and where the service fees are for that. When you take those things in consideration where they actually are, you see that we actually are more at a 2% interest rate right now. And Powell even alluded to that, even though he ruined it by saying, well, we don't know what's going to happen in December. Just because he couldn't help himself. And they need pawns. You're the pawns, and he plays with the pawns. And so he just couldn't help himself. We already talked about how political he is in the last couple of episodes, but my point is, just like we heard from the over 90% of the economists who were recently at a big economic summit, they basically said the thing that really is hurting the economy, housing market, whatever, is the Fed's fund rate being way too high. So when we say where should we be, well, we're already way behind. Powell is already way behind. He said we can always play catch up. A lot of the other Fed governors have said that too. We could play catch up. But Stephen Myron, in another video I'm going to put together here for you, basically says the same thing Barry Habib has been saying, and that is that the inflation rate, when you take the owner's equivalent rent, which is totally ridiculous, and you take the jobs numbers and the aggregate data, you see that the jobs numbers are horrible. And you see what you see, the inflation is much lower than being reported if you are not looking in the rearview mirror and you're looking at the now. And so our Fed fund rate should be much lower. It should be, in the neutral range at the least, if not lower. So, should we lower the rate? Should we not? Well, we should have already been there. So now we are playing catch up, and we have been playing catch up. So, guys, that's it for what it's worth. I just thought this might be a little helpful for you in understanding what this might mean, kind of some different angles on it. Again, I'm all for options out there. This may be an option to get people into the game of life, so to speak. I think getting the Fed fund rate under control is going to be really the end game. Where we're really should be knowing what's going on in the jobs market, um, seeing all the layoffs coming up, seeing where we're really at in the jobs market, where we really are in inflation, and so I think that's really the way to fix it. And can use those buy down rates right now and get lower rates and lower payment right now. And you can always pay down more if you want. So, anyways, guys, we'll see you next time. Thanks.